Two friends. Same age, same starting point, $50,000 each, sitting in a brokerage account, waiting to be put to work. One of them hears about a coworker who turned $8,000 into $80,000 on a single stock. He starts building his own portfolio, 15 companies, handpicked, carefully researched. The other buys one fund that owns 500 companies at once, and does nothing else. For the first 3 years, it isn't close. One of these men looks like a genius at dinner parties. The other looks like he's playing it safe, maybe too safe. But one of them is making a mistake that won't show up on a statement for over a decade. Most people never calculate what it actually costs. Let's keep this fair. Before we compare outcomes, we equalize everything else, because that's the only way the math means anything. Both investors are 32 years old. Both earn $95,000 a year. Both invest $12,000 annually, every year, for 20 years, through the same brokerage. Neither inherits money. Neither has a windfall. Neither times the market. They simply invest, on schedule, every year. Investor A puts 100% of that money into a low-cost S&P 500 index fund, expense ratio of 0.03%. Investor B builds a 15-stock portfolio based on research, conviction, and periodic rebalancing whenever something feels right. Same capital, same timeline, two completely different structures. In year 1, Investor B picks a stock that doubles. It becomes his dinner party story. Friends start asking him for tips. He feels like he's found an edge, like he's outsmarting a system that rewards patience over skill. Investor A's index fund, meanwhile, does something quietly unremarkable. It goes up when the market goes up. It goes down when the market goes down. There's no story to tell, no conviction to defend, just a number that moves without anyone's permission. One of these experiences feels like winning. Let's run the optimistic case, because it's the case most people actually see. Investor B's 3 best picks returned 40%, 65%, and 120% over 3 years. Meanwhile, the index fund grinds out its usual 9 to 10% average. By year 3, Investor B's portfolio sits near $61,000. Investor A's sits near $47,000. On paper, this isn't a debate. Stock picking looks like the clearly superior strategy for anyone willing to put in the research. Most people never even attempt to beat the market. The ones who do this well look like they've cracked something everyone else missed. Until you subtract what nobody talks about. Here's what the surface math left out, for layers, each quietly eating into the advantage. First, taxes. Frequent rebalancing triggers short-term capital gains, taxed as ordinary income, as high as 37%, while the index fund's buy-and-hold structure defers almost all of it. Second, concentration risk. 15 stocks is not 500. One earnings miss, one bad sector rotation, and 2 years of gains disappear in a single afternoon. Third, behavioral drag. Long-running investor studies consistently show that individual investors underperform their own fund's actual returns by 1.5% to 3% annually, not because the investments are bad, but because the investors panic sell and chase entries at the worst possible moments. Fourth, time cost. 5 to 10 hours a week of research is an unpaid second job with no guaranteed return, and it conveniently excludes the 3 losing positions Investor B stopped mentioning at dinner. The surface math wasn't wrong. It was just incomplete. Fast forward to year 10. After taxes, after 2 drawdowns from concentrated positions, Investor B's portfolio sits near $340,000. Investor A, compounding quietly and tax efficiently the entire time, sits near $410,000. Fast forward again to year 20. The gap doesn't shrink, it widens. Investor A reaches roughly $1.1 million through 2 uninterrupted decades of compounding. Investor B, despite real wins along the way, lands near $780,000 after cumulative tax leakage and one catastrophic single-stock loss in year 14 that erased 3 years of progress overnight. A 1 to 2% annual difference in effective return doesn't look dramatic in any single year. Compounded across 20, it becomes a 6-figure structural gap that no single great pick can undo. None of this makes stock picking irrational. Some investors genuinely outperform through discipline, deep research, and a risk tolerance most people don't actually have. Concentrated positions have built real fortunes. Early holders of Amazon or Apple didn't get there through an index fund. Index funds carry their own risks too. They offer zero protection in a systemic, market-wide crash, and by design, they guarantee you'll never meaningfully beat the average. Stock picking isn't wrong. It simply demands more from the investor than most people are honest with themselves about. More time, more tax awareness, and more emotional control than most of US can sustain for 20 straight years. So the real question was never which strategy wins. It's which strategy you can sustain without sabotaging yourself along the way. Wealth isn't built by the strategy that wins in theory. It's built by the strategy that survives your own behavior. Before you choose a side, ask yourself honestly, are you choosing this path because the math supports it, or because the story feels better? The answer that includes everything, taxes, behavior, time, and risk, is the only answer that matters.